Okay, let's go ahead and get started. So thank you very much for joining our Hidden Dangers in the Cyber Policy webinar. Today, Jason Booker will be speaking with you. He is our Senior Underwriter in the Cyber Protection Package Program. And we also have Matt Kletzley, our Management Liability Practice Leader, who may be chiming in from time to time. So just a few housekeeping items. This presentation is being recorded, and the slides and presentation will be available on our website tomorrow or early next week. You will receive an email with the link to the presentation. Should just hold tight for that. And everyone is currently on mute, so if you have any questions, please utilize the questions chat box. Send them in. I will get them and relay them to Jason at the end of the presentation. So no further ado, I will hand it over to Jason.
All right. Thank you, Jillian. I also want to thank you all for your time this afternoon. I really appreciate you guys' interest in our program and also in cyber insurance. This is a product that we're very fond of and truthfully we're very excited about. Today we're going to try and address what we classify as basically it's hidden dangers in a cyber policy. You know, a cyber policy is a pretty challenging product. And I think every agent and broker who's working with it has the same challenge of trying to basically just translate what the language is trying to accomplish. And I want to bring your attention to some different conditions or potentially dangers within the policy and application process, so you can better represent the needs of your insured. There you go. So here's just kind of a quick outline of where we're going to go. And again, if you have any questions or if there's something that you feel that we have bounced across too quickly, please do not hesitate to pop up a little note there in a chat, and Jillian will try and get those responded to. And after the webinar, if you have any additional questions, please don't hesitate to reach out to Matt or myself or any of our team members here. We'd be happy to try and find an answer for you. Oops. Hit the wrong button. All right. All right, sorry about that. So why are we talking about this? So cyber insurance is a pretty new and emerging insurance product that is designed to address basically a new and emerging risk of cyber perils. The truth is that exposures literally change and emerge constantly. And also insurance policies themselves are changing and emerging constantly to try and keep up with the peril. In addition, there is a huge variety of insureds with literally endlessly variable levels of sophistication. So you have a carrier that is trying, pretty much every carrier out there is looking at risks ranging from a one-man accountant shop up to a global multinational public corporation and every single style of company in between. So designing an insurance product or a family of insurance products to address that wildly divergent potential of insureds is a exceptionally large challenge. And in addition, you could be looking at two similar insureds on paper. Let's say it's two restaurants of 3 locations and 10 million revenues. On paper, they should appear to be the same, but these two entities could have wildly divergent opinions towards cybersecurity. One of which that is their passion, and the other they couldn't care less. So designing an insurance policy and a program to adequately address the huge amount of differences of insureds and the huge differences in opinions of the way that they respond to cyber insurance is a pretty significant challenge. Adding to this challenge is that there is next to no case law or court precedent. These are things that insurance carriers typically rely upon to kind of guide and frame both their risk and their breach and their claim response to the losses which they cover. And in cyber, literally every loss is kind of a new experience for every carrier across the board, because there's nothing that they can refer back to define this is what should or shouldn't be applied as far as cover. And then complicating ever further is that there's very limited regulation and very inconsistent standards applied towards cybersecurity and the protection of information. So while there are data laws that apply towards the protection of personal information, there are not data laws that apply towards, let's say, the frequency of which your backup procedures, your data must be backed up. And there's little to no standards that would apply towards the backup frequency or level of depth of what information should be backed up. So these challenges make, again, very hard for how an insurance carrier can adequately estimate and frame the risk. So carriers and reinsurers, they desperately need to address the morale hazard. And the morale hazard is the risk that insured will simply not care to adequately protect themselves or protect, to protect against the potential of a risk. So carriers and reinsurers, they may try it through exclusions, they may try it through definitions, but they rarely will address the insured performance for cyber risk, because how could you potentially address a peril that is changing literally hourly, no standards, no regulations, little to no case law precedent? It's very difficult to do. So one of the best ways to try and address the morale hazard is via the policy conditions. And so in order to kind of frame this presentation, I want to highlight a specific condition in our policy. So this is most notably in our deceptive funds transfer cover in our digital crime cover. So the deceptive funds transfer cover is designed to address a new and emerging risk, which is an event where an insured is tricked or deceived into paying their own funds to a criminal as a result of a false or fraudulent electronic message. This is a modern variant of a scam as old as money itself, but it's constantly changing, constantly evolving. Tactics are ranging from exceptionally low-key to unbelievably sophisticated in order to target businesses to basically release their own money. So the insurance policy is designed, it has to be designed broadly enough to address this risk that is changing hourly, yet framed appropriately to not pick up risks they hadn't intended. So for example, our policy carries a condition that says, cover the loss, provided the authenticity of such transfer request is verified in accordance with your internal procedures. So it's not an exceptionally restrictive condition, but it states that it requires that payment be verified in accordance with your internal procedures. We aren't saying that you must have the CEO, his sister, and his brother all verify the payment. It simply requires it to be within your internal procedures. So for example, here at Victor O'Shinner, I don't have any authority to make payments to a carrier or make any payments really of Victor O'Shinner's funds. So if I am tricked by a Nigerian prince into paying a $5,000 down payment and a $5 million reward that I am apparently going to be availed to, if I pay Victor O'Shinner's funds trying to get that $5 million, the policy will not cover that loss because the authenticity of that transfer request was not within accordance of our internal procedures. Whereas if our accounting department, if they were tricked or deceived into making an otherwise valid payment, and she went through all our normal internal procedures to make sure that payment goes through, even if she was tricked by some guy who's purporting to be a Nigerian prince, the cover should apply to that loss. So conditions are really important to make sure that the policy doesn't over-respond to events that they hadn't otherwise intended. So, moving on. So is this just another cyber scare tactic? So cyber insurance, I think, is one of the more notorious lines of business that utilizes scare tactic marketing to try and goad businesses or agents into the purchasing or consideration of cyber insurance. This is not the case. This is an emerging trend that I have closely been watching, specifically on the applications, and I don't think that it's getting the attention it deserves. And there are some recent events that really drive home the importance of this condition. Most notably is the CNA versus Cottage Health System. So this was a recent disclaimer where CNA declined to pay a $4.1 million settlement, which Cottage Health System was looking to cover off of a class action lawsuit following a breach event of their health records. So in this case, a web page or a website that hosted the record information was made viewable to the public unencrypted. Therefore, about 30,000 and change records were made viewable to the broader public. And part of the trying to resolve this loss was this offered settlement of $4.1 million. CNA disclaimed the payment because there was an exclusion and an application provision that required that they continuously implement procedures which were noted in the application, most notably the encryption of all records and storage. So they applied the disclaimer because the insured clearly did not continuously maintain the condition that the application provision which stated that they would encrypt data at rest. because obviously if it was viewable to the public outside of their system, clearly was no longer encrypted. Therefore, the exclusion and condition could apply. This loss actually was settled out of court. They kind of came to the ground in between, but this was kind of an opening salvo, I think, that was a bellwether of sorts that brings attention to this particular condition that everybody needs to pay attention to, because it is going to start applying towards the coverage of losses. And continuing on the fact that this is definitely not a scare tactic, although utilizing a scare tactic, if you will, is to address the policy condition impact of a recent event, most notably the WannaCry virus. So the WannaCry virus got a lot of news. It was very exciting, but it brings to light a very important condition that I don't think many understand. So the WannaCry virus was designed to exploit a recently discovered vulnerability in Microsoft software. So this happened back in March. Microsoft pushed a patch to fix the vulnerability. It was a file transfer, some sort of allows computers to speak together to better adequately share information. They pushed out a patch to basically better protect that sharing mechanism between their Microsoft operating systems. However, Microsoft only pushes out patches for current software packages that are live and no longer retired. The WannaCry virus primarily impacted retired software packages, including Windows XP and Windows 7. Of the global operating systems impacted by the WannaCry virus, approximately 97% of all infected computers were actually running the Windows 7 operating system. So big and so clearly impacting the Microsoft operating systems that Microsoft took the highly unusual step to release a patch for the retired packages to try and stem the flow of the WannaCry virus. So many policies actually exclude or they have a condition which precludes cover for the use of any unsupported or retired software packages. In addition, many applications ask about, does the insured utilize an unsupported or retired software packages? It's a question that on its own seems very innocuous. You know, why for does this matter? I mean, this happens, but why is software really retired? So we live in a world where technology is evolving constantly. It's improving constantly. It's increasing in speed. It's increasing in functionality. It's increasing in all kinds of capabilities that at a pace that is just mind-boggling. And as a result, software doesn't always evolve to keep pace with those improvements. So a software package is oftentimes retired when it no longer is compatible with the current standards of technology and can no longer deliver the level of performance that was advertised as before. So as a result, Microsoft and other software companies themselves retire software packages as an attempt to try and keep their clients on the most current and most whiz-bang product. It's not necessarily an evil genius way to try and force people to buy new software packages. It's simply to keep them moving forward with the times. And in the case of Microsoft XP, Microsoft actually offered an upgrade to Windows 10 as a free of charge upgrade to operating systems to try and ensure that their clients were receiving the best potential service that they expected and desired. And for a fun little anecdote, we here at Schinner, we actually utilize Windows 7 as our operating system. It's on a home-baked image, but it is somewhat common that Windows 7 is in play still across the board. So it's not like it's a means of laziness or other problems. It's just it's not always easy to upgrade software systems. But this condition or exclusion should definitely be paid attention to.
So Jason, just to jump in real quick here. A survey last spring of U.S. and U.K. firms came to the conclusion that 44% of the firms in the U.S. and the U.K. are still running XP, and it's been retired for 3 years, which means it doesn't get any patches and it has this type of vulnerability. So this is a very real, very prominent aspect of business risk for a lot of customers and clients. So it's something to be aware of, something to understand this entire concept around retired software and what the risks are to the business at the end of the day.
Right. And as insurance agents and brokers, in your risk management capacity, if this is a condition that is ubiquitous across insurance policies, which actually isn't the case, but it's somewhat common, it's something that you need to approach in a conversation with the insured. It doesn't necessarily mean that they are no longer available of the cyber insurance. It's just that they need to make the decision. So if there is a loss that may arise from their use of unsupported software, are they willing to accept the self-insurance provision of that loss? And that may kind of drive their decisions thereafter, whether they upgrade software or continue just basically fund for the self-insurance of that loss. So it's just conditions that need to be paid attention to by an agent or broker. So some policy conditions to pay attention to. The use of unsupported retired software, as mentioned. This may include unlicensed software. So the WannaCry virus actually impacted a lot of bandit software in countries that utilizes unlicensed software, like China or other countries. That use of that software may not be covered by a loss under some insurance policies and some insurance programs. Another condition that really needs attention is security which meets or exceeds that which is represented in the application. Again, this is similar to that CNA disclaimer that was disputed and brought forward in court. But this is really important to note because not all security questions really are yes/no style questions. I bring to you, encryption, yes, no. Is all data stored or all data transmitted encrypted? It's not a yes/no answer because encryption is much more complicated than simply an affirmation. Is encryption utilized? Oftentimes, yes. But is it always utilized across every communication and business performance? No. And that requires some real attention. Another question that I see pretty frequently is the requirement to educate or review privacy policies annually. A larger corporation, yes. We regularly are participating in training modules and other that are educating us on our privacy policies and what we need to do internally. But I've also worked at smaller companies that we didn't even have a privacy policy. So that condition can really come into play, especially for in the smaller risk cyberspace. Another condition that, or another question is whether or not firewall or security is patched and updated. Smaller companies, that may not always come with be. Another policy condition to really pay attention to, and I'm actually seeing this as a real trend, an increasing trend, is to obtain and maintain PCI or regulatory compliance. And as discussed in our earlier webinar series about PCI compliance, PCI compliance is not simply utilizing a PCI compliant vendor. It's a much deeper process that the vast majority of businesses are basically unaware of in full. So when they click yes, that places both the insured and the agent in a potentially dangerous situation. In addition, I also put this as an additional point, the keyword to maintain. So a fun little anecdote about PCI, they have never found a business that has sustained a payment card loss to have been PCI compliant. They found some elements of their security or procedure to be in violation of PCI compliance. Therefore, they have never had a PCI compliant business actually compromised. The likelihood of that being thrown at you in a loss is pretty low, but it's still one of those things there. It kind of makes me smile. But moving on. Let it go. Sorry, I got a new computer and I'm hitting the wrong button here. So the next point, cyber application provisions to pay attention to. So these are some questions that you really need to pay attention to in some applications. I'm seeing this as a trend that I'm not wild about. I don't mind provisions and conditions in the policy itself, but when they're added to the application, which is then affixed to the policy, oftentimes these applications carry an affirmation which the insured is basically clicking to or agreeing to that I think has broader implications than what they actually understand. I'm not wild about it, but I'm seeing the questions for, again, the PCI compliance. So if the insured is wanting fines and penalties cover, they must affirm PCI compliance. Again, a mere clicking of yes doesn't necessarily mean that they've accomplished it, and that's something that I think definitely needs attention. Some questions that I've seen recently that have popped up in applications. Do you have a prominently disclosed privacy policy and do you honor it? That's a pretty strong question. So what is prominently disclosed? Is this on their website? Is this in the cafeteria? It's not well defined, and I'm not fond of it. at least annually? Do you provide security awareness training for everyone who accesses your network? Again, small businesses, this may or may not be something that an insured can meet. Do you limit access to data on a need-to-know basis? That's such a broad, open-ended question, and I should point out that these questions came with a yes or no response. And these questions were designed specifically for a business that had revenues of $5 million and below. So I don't find, these are questions that are really populating and starting to show up on applications for cyber risk for small business that are just kind of being a little surprising. It is really important to note that these applications, again, they affix to the policy. They carry the strength of policy language. And this specific application included a phrase that said, the applicant has answered yes to all questions included in the application and agrees to continuously implement these controls throughout the policy period. That's an exceptionally strong affirmation which the insured has agreed to that really requires attention. And in addition to simple security procedures or protocols, many applications carry prohibited activities or services. And these are not necessarily with evil intent. It's just that in the increasingly automated space for cyber risk and also other lines of business as well, there's certain classes of business which an insurer simply seeks not to cover. And so the insured and the agent as well should familiarize themselves with specific markets, know each of their prohibited activities or services. So if you know that, for example, Victor Schinner does not do universities, sending a university our application, and if they miss that question, that's something that they need to kind of that everyone needs to kind of pay attention to. And then again, just pay attention to the gotchas. So in addition to the questionnaires, encryption for stored data. Again, I'm really hammering on this encryption thing, but something I feel pretty strongly about. It's a condition that really needs attention. Let's see here. Let's go next. I go a little further. So again, if y'all have any questions, the policy conditions, it's not an evil intent or an evil action by an insurance carrier to try and disclaim or avoid covering of losses. This is really it's a way that insurance carriers can frame the risk and try and keep current with the risk as they constantly and perpetually evolve. If you have any questions regarding our policy, how our policy may stack up against others, if you have questions about a particular application or what the impact of a condition may be, please do not hesitate to contact any of our underwriters here on the team or our partners at Mullen Coughlin. Contact us obviously first. We will definitely work real hard to try and find any answers or responses to any of your questions. And then again, Matt Cutzley and I are always available to any questions that you might have. This is kind of what we do, so this is what we're here for. And with that, Matt, if you have any additional points, I also open up the floor to any questions that you may have regarding policy conditions or provisions.
Yeah, I think it's thank you, Jason. Let's just open the floor to questions at this point, and Jillian will read them out. If you have any questions, please type them into the chat box and send them over.
Okay, here we go. First question. Does your social engineering coverage extend to transfer of client funds?
So the transferring of client funds, that's a third-party loss. That's a liability component of policy, not a cybercrime component of policy. So if the third party, if they have sustained damages or harm as a result of the insured's failure to secure the information or the insured's failure to secure their computer system, it would be an otherwise covered loss, then that loss could be compensated by the policy. Okay.
Will Schinner be planning on writing tech-based businesses in the future?
Matt?
So the question was, will we be contemplating moving our current policy into the tech space in the future?
I'm assuming.
Okay, so what our policy really wasn't designed for the tech E&O space. We pulled all tech E&O components out of it to make it much easier to read and really make it for mainstream America. We like to joke it's Main Street America is what our target audience is. So we don't have those provisions built into the policy, but believe me, we'll definitely have a webinar if we ever decide to open a tech E&O cyber combination policy.
Okay, does your electronic transfer of funds and deceptive transfer coverages apply to loss of an insured's client's funds?
Clients. Okay, so whether the electronic funds transfer loss or deceptive funds transfer loss would apply towards a client's funds, again, that's a third-party value, a third party or the electronic funds transfer fraud and the deceptive funds transfer fraud addresses a emerging cover gap of crime policies, which address the loss of the business's own money or securities. Their traditional crime policy has limitations for where electronic transfer fraud can be covered, and they typically carry a willful parting exclusion, so events where the accounting department authorizes the payment of those funds wouldn't be covered under a crime policy. So our cybercrime is designed to address that emerging gap. But again, if loss of when a client or a third party loses funds, that's a traditional cyber liability peril.
Right, and it's an interesting question because it's a challenging question. In certain of our spaces that Schinner is a well-known name in, the insured may not even have any care, custody, or control of client funds, and yet the clients are parting with their funds themselves. There are other transfers that are happening. So it's actually a really complicated space. It's an interesting question, and we can talk more about it in person and offline. But the crime provision that we've provided in the endorsement to the policy is about the willful parting of funds from the insured, and our contemplation of that in this policy was from questions from insurers of why wouldn't the crime be covered if it's a cyber attack that hit our system and someone fraudulently produced an email. And from that all the way through, a lot of the clients that we were looking to help to get cyber coverage for may not have a package policy where social engineering endorsements are available for the crime coverage. So that was kind of the purpose behind it. But if there's an opportunity to build out or if there's an opportunity to discuss it further, we can do that offline.
Okay, a couple questions on clarification. Just to clarify, you were saying that the Schinner product does not require encryption of stored or transmitted data. Is that correct?
We don't have any conditions for that, no. And we don't have any application provisions that again, could apply towards the elimination or preclusion of cover.
Okay, another clarification. The deceptive transfer coverage does not require verification of the authenticity of the request.
Correct. But
go ahead.
So our policy does not require so there are some policies which carry a condition that requires a dual mode authentication of the communication. What that would be is if you receive an email, then you need to contact the sender of that email in a different mode of communication to verify the authenticity of that request. Some carriers find that to be a reasonable expectation, others not so much. I personally find it to be quite onerous and unrealistic. I feel that our condition that states that the authenticity of such transfer request is verified in accordance with your internal procedures to be the best way. So for a slightly more sophisticated business with a deeper accounting department, they may have internal procedures that require a second person to authorize the payment of funds, whereas a three-man property distributor may not have the staffing to verify all those kinds of things. And so I think our flexible condition adequately frames our response, I think is kind of the best way to put it.
Yeah, I think to put it in perspective, many companies only go to dual authorization over a certain level of fund being released. So if the funds are over $5,000, then you have to have the dual authorization. That would be something that if that was their procedure and the funds were released at $5,100 and it wasn't followed, that would be where the condition would come to play. But if it was a $3,500 release of funds, and to Jason's point earlier, the sophistication is it looks like it's coming from a vendor that the organization trades with regularly. Often they'll actually look like the size of the invoices that they get from that vendor. The email will look like it came from that vendor. The call will come from a number that looks like the vendor's number. So all of this, and it's a rush pattern, and what happens is when it goes out, it looks like the authorization has been brought down from internally inside the organization often. Either a CEO or a CFO requesting it. I had a cousin who got a call from his CFO and said, why are we sending this money to these people? And he's like, what are you talking about? And it was someone who had just mimicked the email address. And it looked like it was a legitimate size of an invoice they typically end up paying to that particular vendor. So the sophistication is quite high, but if you have dual authorization for all sides, that means if you send something that's $200 instead of over $5,000, it's not dual authenticate. It wasn't authenticated by two people, then it may not be covered under that policy. So ours is basically, as long as you follow your own rules, the coverage is afforded.
Okay, another clarification. Clarify, your policy does not exclude claims for breaches on retired operating systems. Is that correct?
Our policy does not carry any exclusions or conditions related to that. That's correct.
Okay. Most small business policies now have endorsements available for very small premium. They do seem to be less complicated, but would it be safe to say they would have much less coverage? Says the challenge for us as agents is the wide variance in terminology.
I understand that in full, the challenge agents face. One of the opening lines I make when I walk in the door at any agency is that I apologize for being number 67 in the door today to talk about cyber. It's definitely a little bit of information overload. I think the best protection for agents is to familiarize themselves with a handful of key partners for different key needs. I mean, no single property market is going to be the adequate property market for every insured, ranging from a large hotel operator on the coast to a small restaurant in the Midwest. Right? You need a variety of property markets to address the variety of potential property exposures to all your insureds. Same thing with cyber. So familiarize yourself with a good partner for small, $0 to $150 million Main Street style risks. I think that Shinra is a leading partner that should be of value for that. For exceptionally small insureds who simply $750 that's nice, but that's just more than they wish to pay for a cyber insurance. Familiarizing yourself with a good GL market that has a good endorsement package for that cyber risk is a good procedure to do. I think the biggest challenge is to wade through the noise and find the partners that you can work with.
Yeah, and the one thing I would add to that is recognize what is or isn't going to be in that policy and where claims come from. So we've spoken at length across many webinars about the fact that most of the claims really do come in the first-party space, first-party coverages. And often those endorsements, familiarize yourself with what you're getting in the endorsement. If there's no first-party coverage, if there's no data breach coach that's going to come in and help to walk them through the process, if there's no payment for those coaching situations, which is also a law firm, so it's privileged communication, or the mitigation of the breach itself with forensics teams, or any of the regulatory expenses if there was lost data that has to be reported to regulators. Even small companies in today's digital age are across multiple states, which puts them across multiple jurisdictions for rules and regulations on reporting of confidential information. So when you look at the total picture, the losses aren't as prominent, and especially in the small to mid-market space for the liability side, the losses are more prominent for the organization to be able to sustain itself, to be able to get past the breach, and then also to recover the confidence of the clients with the use of a PR firm. So keep that in mind when you're looking at endorsements.
Okay. What is the general cost of a single cyber claim that you have seen, and is there a certain range you tend to see?
As far as range, the challenge of cyber risk is that it's each unique, and each exposure and risk loss is typically unique. But just looking at the loss runs from last month, we had a ransomware event which incurred a little over $15,000 in forensic expense, just simply looking through, and this is a very small insurer, to be honest, looking through their systems to ensure that no private personal information had been compromised or put at play. And I think our ultimate resolution expectation is about $25,000 on that little ransomware event. Our partner Chubb, their experience is closer to $150,000 for the average opening of a breach response loss. I believe it's between $125,000 and $150,000, and that's forensics, IT, notification, and other. And that's ranging everywhere from loss events where it was discovered that ultimately there was no loss to respond to, clear up to significant breach responses, which they had to be involved with. So, Matt, any other points?
Yeah, so we like to look, because we're on the higher volume level of the spectrum rather than the really large account spectrum that has some of the really exceptional numbers attached to their losses. We prefer to look at the median rather than the average numbers. And when you look at the medians sit just below $30,000 for the average breach response that has no regulatory reporting, and it's simply going in, remediating, making sure they're addressing the issues that need to be addressed, doing the forensic work that has to be done. So when you take a look at the spectrum, and then you look at the premiums that sit for us, our median premium is just over $2,000. And you look at the time range of everyone saying, and we agree, it's not a matter of if you'll be hit, it's a matter of when. So then you look at your horizon. If your median price is just over $2,000 and your median loss is $30,000, it's quite a few years of coverage before you feel like you've sunk more into the securing of the coverage than you've received in payment. So just a little bit of risk to risk mitigation perspective.
Okay, one final question I see so far. Is there a charge for the insured to use the data breach coach?
Well, as far as whether the charge for the data breach coach, if it's for a covered loss event, the expenses charged by the data breach coaches are covered by the insurance policy. So their legal advice and their hours and time spent is covered by policy. So it's not an out-of-pocket loss scenario, loss expense for the insured. If they wish to contact our breach coach team at Mullen Coughlin for advice, risk management advice, or other, then that would be it's outside of the covered loss events. That would be an out-of-pocket expense.
Yeah, and the only other expense they would have in the event of a loss would be the retention that they have on the policy. So that's the only additional expense, but that's just part of the policy terms and conditions. As far as the way that the data breach coach is activated, it's when there's a suspected breach. So we actually do have really broad language for contacting the data breach coach in the event of a suspected breach. And the great part about that is they start walking you through the process from the first call of exactly when can we get together and really start to dig in with this information, straight through the resolution and their final letter, wrapping everything up that also includes the forensic findings.
Okay, it looks like that was the final question.
Thank you, everyone. We appreciate your time. Have a great day.